Let me ask you something. What if I told you that one of the most profitable companies on the planet, a business with 68% gross margins, a $160 billion operating cash flow engine, and one of the most powerful enterprise ecosystems ever built, was sitting roughly 28 to 30% below its 52-week high? That company is Microsoft. And the question I want to answer today is not just whether it's cheap. That's the obvious question. The real question is, has the business actually changed? Has something broken? Or is this simply the market repricing what AI is going to cost? Because those are two very different things. And if you can answer that question clearly, you'll know exactly what to do with Microsoft today. So let's break it all down. We're going to go through the latest numbers, the big macro debate around AI spending, the bull case, the bear case, and then I'll walk you through my full updated valuation, and I'll give you my honest verdict at the end. Let's start with the contradiction, because this is where most investors get confused. Microsoft just reported earnings, and by almost every headline metric, the results were excellent. Revenue came in at $83 billion. That was a beat. Earnings per share of $4.27. Another beat, and well ahead of the $4.06 consensus. Year over year, revenues are up 18%. EPS is up 23%. These are not the numbers of a company in trouble. And yet, after those results, Microsoft was one of the largest red names in the entire S&P 500. Down 3 to 4% on the day. And when you zoom out to the 52-week picture, we're looking at a stock that has fallen roughly 26 to 28% from its highs. So let me be direct. This is not a company that missed. This is not a company that cut guidance. This is not a company where something went wrong with the core business. What this is, and this is the key insight, is a market that is no longer willing to ignore the cost of the AI build-out. That is the real story. And to understand why, you have to understand what Wall Street was actually watching during the earnings call, because the reaction was not straightforward. Azure, Microsoft's cloud and AI platform, grew at around 39% in the most recent quarter, right in line with what analysts had expected. But in this market, in line is not always enough. When the stock is priced for excellence, it needs to beat the whisper number. And initially, Azure was right on the line, not above it. Then about 25 minutes into the earnings call, management provided guidance. Azure growth for the June quarter is expected to come in at around 40%. That was ahead of the street's estimate of 37%. The stock initially moved higher. Then, as investors processed the CAPEX numbers, it gave it all back. That sequence tells you everything. The demand side of the AI story is not the problem. It's the cost side. And that is what the rest of this video is about. Before we get to the cash flow problem, let's be fair to the business, because the income statement is genuinely remarkable. Gross profit at $56 billion on $83 billion of revenue. That's a 68% gross margin. Operating income at $38 billion, a 46% operating margin. Net income of $32 billion, a 38% net margin in a single quarter. Most companies would not earn that in revenue in an entire year. Microsoft is generating it as profit in a quarter. When you break the business into segments, the picture is even clearer. Productivity and business processes, that's Microsoft 365, Teams, LinkedIn, generated $35 billion, up 17%. Intelligent Cloud, that's Azure and Enterprise Services, also generated $35 billion, up 30%. More personal computing came in at $13 billion, slightly down year over year, which is fine because nobody is buying Microsoft for the PC business right now. The growth engine is unmistakable. It's the cloud. It's Azure. It's Microsoft 365 Copilot. It's the entire AI infrastructure stack. And that growth is real, it's large scale, and it's already being monetized. This is actually what makes Microsoft different from some of the other hyperscalers. Microsoft is not just spending on AI for internal use. It's selling AI capacity to external customers. Enterprises are paying to use Azure. Developers are paying to use Copilot APIs. That is a meaningful distinction. The monetization path is visible. So I want to be very clear on this point. The income statement is not the problem. If you stopped here, you'd probably say this is a great business and a buy, and you might not be wrong. But you can't stop here, because when you move from the income statement to the cash flow statement, the picture becomes more complicated. Here is the slide that I think defined this earnings season for Microsoft, and honestly, for the entire AI trade. Capital expenditures, including assets acquired under finance leases, $32 billion. That's up 49% year over year. Cash paid for property and equipment, $31 billion, up 84%. And free cash flow, $15.8 billion, down 22%. Read that again. Free cash flow, the single most important measure of what a business is actually generating for shareholders, fell 22% in a quarter where revenue was up 18% and operating income was up strongly. That is the tension at the heart of the Microsoft story right now. The income statement almost looks perfect. The cash flow statement tells a different story. And when you zoom out across the entire hyperscaler universe, Microsoft, Amazon, Google, Meta, the numbers become almost staggering. U.S. hyperscaler capital expenditure is estimated to approach $715 billion in 2026. Microsoft's portion alone is estimated around $190 billion. That is not a rounding error. That is a structural transformation in how these companies allocate capital. Now, I want to be careful here. High capex is not automatically bad. In fact, if Microsoft is spending heavily because demand is genuinely enormous, if enterprises are signing long-term Azure commitments faster than Microsoft can build infrastructure to serve them, then this spending is exactly right. You want to invest into a supply-constrained demand environment. That's how great businesses get built. And there is evidence of this. Microsoft's commercial remaining performance obligations, the forward backlog of signed customer contracts, remains very large. Cloud backlog across hyperscalers has grown sharply. These are real customer commitments, not speculative demand. But the market is asking a harder question. Is the spending creating high return growth, or is it becoming the permanent new cost of staying competitive? Because those lead to very different valuations. If AI infrastructure investment is a one-time catch-up, build the capacity now, cash flows normalize in 2 or 3 years, then the current free cash flow pressure is temporary, and this sell-off is an opportunity. But if AI infrastructure is more like a treadmill, you have to keep spending just to maintain your position, then the old Microsoft multiple may genuinely not come back. That is the debate. And the market is not yet sure which version we're living through. That uncertainty is what you're seeing in the stock price. Let me give you the strongest version of the bull case because it is genuinely compelling. The demand is real. Full stop. AI companies, Anthropic, OpenAI, and the broader enterprise ecosystem are scaling from nearly zero to enormous revenue run rates in just 2 years. These companies need infrastructure, they need compute, they need Azure. When you look at what Anthropic and OpenAI are generating in aggregate revenue today versus where they were 24 months ago, the growth rate is extraordinary, and Microsoft is the infrastructure layer powering a significant portion of that growth. Azure is not speculative. It is being consumed at scale today. The bull also points to the supply constraint. The issue is not demand softness. It's whether Microsoft can build data centers fast enough to meet the demand that already exists. That is a high-quality problem. A company that is supply-constrained is not a company in trouble. It's a company that needs to invest. And the investment is paying off in Azure growth numbers. 39% this quarter, guidance of 40% for next quarter, ahead of the street's 37% estimate. At Microsoft's scale, growing a cloud business 40% year over year is genuinely impressive. This is not a tiny startup growing from a small base. This is one of the largest cloud platforms on the planet. The bull case also extends into the software layer. Microsoft 365 Copilot is live across enterprise accounts worldwide. Copilot Studio, Azure AI Foundry, GitHub Copilot. These are not experiments. These are monetized products being deployed at scale across millions of enterprise users. The AI revenue opportunity is not just infrastructure. It's the software layer on top. And the balance sheet provides cover. Net debt to EBITDA is extremely low. Microsoft is not a company being forced to cut spending because it's stretched. It has the financial strength to invest through the cycle and emerge with a stronger competitive position. If you believe all of that, and there's good evidence for it, then the conclusion is clear. Microsoft is making the right capital allocation decision. It's building the infrastructure layer for the next decade of enterprise AI. And the free cash flow pressure is temporary, not structural. In that scenario, buying at today's prices is almost certainly a mistake you won't regret. Now let me give you the strongest version of the bear case because it deserves to be taken seriously. The central concern is this: compute revenue is not the same as compute cash flow. Even if Azure grows strongly and AI monetization continues to ramp, the question is how much free cash flow survives after the spending required to generate that revenue. And this is a genuinely new dynamic for Microsoft. The old Microsoft was an almost perfectly asset-light business. You sold enterprise software licenses and cloud subscriptions. Your marginal cost of revenue was low. Your free cash flow conversion was among the highest in the S&P 500. That is the business the market was paying 30 to 35 times earnings for. Sabri. The new Microsoft, the AI infrastructure Microsoft, may be a very different business from a cash flow perspective. Data centers are expensive. GPU clusters are expensive. Power infrastructure is expensive. Land is expensive. And these investments are not optional if you want to remain competitive with Amazon and Google. The bear points to the valuation multiple and asks, why should Microsoft trade at the same premium if its free cash flow is being consumed at a much higher rate? The market is not saying Microsoft is a bad business. It's saying the multiple needs to reflect the new capital intensity. There is also the question of competitive intensity. Microsoft, Amazon, and Google are all building the same infrastructure. If all three keep expanding capacity aggressively, will AI compute eventually become commoditized? If pricing power in cloud infrastructure erodes, the returns on today's CapEx could disappoint. And then there's the more philosophical risk. What if the AI revenue ramp takes longer than expected? What if enterprise adoption of AI tools is slower than the infrastructure build-out? You'd be in a situation where Microsoft has made $190 billion in capital commitments, and the cash flow to justify it is still a few years away. That's not fatal for a company of Microsoft's quality, but it would absolutely justify a lower multiple. The bear doesn't need Microsoft to fail. They just need the company to spend more, for longer, with slightly more uncertainty about the return. That alone could keep the stock range-bound for an extended period. Before I get to the valuation, let me just do a quick quality check, because I think it's important to separate the stock debate from the business debate. The business quality here is still exceptional. Gross margin, 69%, EBIT margin, 47%, EBITDA margin, 57%, net income margin, 39%, cash from operations over the past 22 months, approximately $160 billion, return on equity, around 34%, return on invested capital, 22%. Those are not the numbers of a business in structural decline. Those are the numbers of one of the most profitable enterprises in human history. I also want to watch ROIC carefully going forward, because if AI CapEx keeps rising and the incremental return on that capital starts to drift lower, the market will continue to compress the multiple. That's the early warning signal to watch for. Right now, ROIC is still very strong, but it's worth monitoring quarter by quarter. The balance sheet is also a genuine asset here. Low net debt, strong liquidity, no forced selling of assets or cuts to essential programs. Microsoft can invest through the cycle. Not every company in this AI infrastructure race can say that. So let me be plain. This is not a business that is broken. This is a great business facing a harder valuation debate. And that distinction matters enormously, because great businesses falling can sometimes be opportunities. Weak businesses falling can be value traps. Microsoft is firmly in the first category. Now let's get into valuation, because this is where the final answer lives. Microsoft is now trading at a forward PE in the low to mid-20s, depending on which estimate you use. Compare that to its 5-year average, which has consistently been above 30. On a relative to history basis, Microsoft is clearly cheaper than it has been in years. That's a meaningful shift for a business of this quality. But cheaper than history does not automatically mean cheap. Microsoft is still a premium business and still trades at a premium valuation. On a price-to-sales basis, it commands roughly a 200% premium to the sector median, even after the sell-off. When I run my DCF model using the latest earnings data, the base case intrinsic value comes out to approximately $489 per share. At the current price of around $447, that implies a margin of safety of roughly 17%. Wall Street consensus is sitting higher, around $555, implying even more potential upside if you trust the street's numbers. Let me walk you through the scenario range. In my lower case, assuming 12% free cash flow growth, the value is around $447. In my base case at 14% growth, $489. In my higher case at 16% growth, approximately $534. All three scenarios suggest the current price is reasonable to attractive for a long-term investor. The question is, which scenario is most likely? I do want to flag the sensitivity here. The key variable over the next 12 to 24 months is not Azure growth. That looks solid. The key variable is how long CapEx stays elevated and what happens to free cash flow as a result. If CapEx remains elevated for longer than expected and free cash flow continues to be pressured, even a great business at a reasonable price can underperform for a period. On the analyst side, the reaction has been split in exactly the way you'd expect. Goldman Sachs and Piper Sandler raised their targets on the back of Azure strength. Truist and Scotiabank cut theirs on valuation reset concerns. That split perfectly captures where the debate sits. The business is excellent, the valuation is more reasonable, but the spending question has not been fully answered yet. So here is my final verdict. Is Microsoft a buy today, or is this a mistake? The business, excellent. Revenue growth, strong. Azure, growing at 40% guidance. Margins, still elite. Balance sheet, fortress. Returns on capital, very high. After a 28% drawdown, the valuation is the most attractive it has been in years. I do not think Microsoft is broken. I do not think this is a thesis-ending moment. I do not think the sell-off reflects a fundamental deterioration in the company. But I also do not think this is a risk-free, back-up-the-truck moment, because the market is asking exactly the right question, and Microsoft has not fully answered it yet. Free cash flow matters. Capital intensity matters. AI return on investment matters. And until we see evidence that the spending cycle is producing durable free cash flow improvement, investors are right to require a margin of safety. So here's how I'd frame it. This is a disciplined buy, not a blind one. If you're a long-term investor with a 3 to 5 year horizon, the current price offers a genuinely interesting entry into one of the clearest AI infrastructure winners. The demand is real. The monetization is visible. The balance sheet can support the investment. But I would build a position gradually. I would not assume the bottom is already in. And I would watch free cash flow as the primary signal going forward. If CapEx peaks in the next 2 to 4 quarters and free cash flow begins to normalize upward, the stock has real room to re-rate. If CapEx keeps rising and free cash flow stays under pressure, the upside is limited even from today's levels. The long-term track record speaks for itself. Over the last decade, Microsoft has been one of the best compounders in the S&P 500. It has outperformed the NASDAQ 100. It has grown revenue, grown earnings, expanded margins, returned capital through buybacks and dividends, and compounded shareholder value year after year. The danger with that track record is that investors get comfortable. They start treating every dip as a guaranteed buy. They stop demanding a margin of safety. They ignore the valuation. This moment is different, not because the business is weaker, but because the AI era is genuinely changing the economics of great technology businesses, not destroying them, changing them. And that means a little more discipline is warranted. Buy Microsoft because the business is excellent, the valuation is reset, and the long-term opportunity is real, but size it sensibly, build it gradually, and watch the cash flow. That is my verdict. Microsoft is one of the highest quality businesses available to investors today. After a 28% drawdown, it is also one of the more interesting entry points in years. Just don't mistake interesting for risk-free. If you found this breakdown useful, make sure you hit the like button and subscribe. Every Monday morning, I send out a free newsletter. Severely undervalued stock ideas, market updates, and what I'm watching for the week ahead. Link is below. And if you want to see exactly what I own, when I'm buying, and my full position sizing, that's all inside the Patreon. As always, have a great day. See you on the next one.